Alright, so let's begin the show. India has a large proportion of self-employed individuals accounting for over 50% of the country's workforce. Now, broad categories can be drawn among the self-employed millennials with an entrepreneurial spirit, traditional family-run businesses and the new age gig workers. It's not a secret that self-employed individuals have certain amount of risk attached to their financial life. Creating financial robustness for them is of paramount. So how exactly can a self-employed individual create a financial safety net for themselves? Let's discuss all of this today. I have with me Nehal Mota, co-founder of Finnovate. Nehal, good evening and welcome to the Money Show. So obviously we're talking about self-employed individuals. Could be anyone, a freelancer, an entrepreneur, a gig worker, or even someone who is just trying to enter the workforce, still thinking about joining the job market or maybe doing something on their own. The question being, people who do not have a regular income, okay? What could be the red flags in their entire financial life or their financial journey according to you?
Good evening, Kavita, and thank you for having me on show, and good evening to all the viewers. There are a few things which we see as a pattern with the financials of self-employed people. First of all, that they mix their personal finance a lot with the business finance. The second thing which we've seen is that at times they don't factor in their own personal expenses or a take home from their business. They would have planned all the business expenses. They would have also forecasted the kind of income they will get. Okay. And then they will think that at the end of the year, if I make any money, that is what I will take home. Okay. So that's a very big mistake which they do. While they are planning the expenses and forecasting the income, they should also factor in a certain take home for themselves. It could be monthly, quarterly, annually, whatever is the bare minimum living expenses. That is what they need to plan, in their finances. For someone who is still thinking that whether he should be joining the job market or he should be an entrepreneur, they need to be really sure that can they actually maintain the lifestyle which they are living for the next 18 months at least. 18 months to say 3-year period, about 1,000 days. Can you actually live on 1,000 days just from the income which the business may or may not generate? Can you sustain for that 1,000 days? If you can, then you should really think of taking this plunge as an entrepreneur and even like have a small business plan, have that visibility that for 1,000 days, if my business doesn't pay me any income, then can I actually sustain the expenses not only of the business but also myself personally. Okay, so these are the few things which someone who is planning to start a company and be an entrepreneur, and someone who's already an entrepreneur, keep this in mind.
So there are two kind of people that I want to elaborate on, when you talk about self-employed people. So there are people who right from the first day they want to become an entrepreneur or someone who has their own business or anything that doesn't involve them being in a job market. And then there are few people who maybe through early retirement or maybe want to have something else to do in their life after spending a particular amount of time in a particular job. The scenario and financial planning and the strategy would be different for both these kind of individuals. Someone who's just starting out as an entrepreneur and someone who has been a part of the job market but now is going on an entrepreneurial journey or maybe doing something on freelance basis. The latter part is still comfortable because they might have saved something, they might have, taken into account the kind of expenses they might have because there won't be a steady income or regular flow. But then what about the first category? If you're starting out as an entrepreneur, okay, and maybe you are too young to even think of what kind of financial goals you want to achieve, how can you just go on with your expenses, planning the buffer amount that you need for your startup or anything that you want to do, because it's not only about funding your business, it's also about funding yourself and you are just starting out. So how do you go about it?
So in this case, it's very important to see the kind of financial support you have. Like till the time your business is not going to get make money, would you or your family manage to take care of the living expenses, or is your family going to support you till that time? That's a very important decision. At times there are youngsters who are wanting to start, who don't want to do a job but they want to take a plunge in the business, but the overall family situation or the financial situation is such that they can't sustain for a very long time, because the family at some point of time expects you to start contributing income for the overall expenses. So you need to be very clear that if you're not going to contribute any income to your family for the next 1000 days, can the family sustain? And forget you contributing income, your own expenses have to be supported. So if the answer is that I have that much of a cushion, or I have some capital to start with, which can take care of my business for 18 to say 3 years, 18 months to 3 years, and even if I don't withdraw anything from my business, my personal expenses are also well funded, then that's a different thing altogether, and you can really think of entrepreneurship in the beginning of the career. But if you are at that stage where at some point of time you contributing income to the family and also taking care of your own expenses is an important consideration, then I would say that you start with a job, do some side hustles till it grows to a certain level that it's comfortably taking care of your own expenses, and you've built in certain capital, or you've got some external funding to take care of the business for at least, like I said, 18 months to a 3-year window, then that's where you decide to really take a plunge as an entrepreneur.
One also very important aspect is that you need to have the right kind of insurance also. These are the basics of financial planning that we are talking about. You definitely need to plan your expenses, your financial goals, and start investments for that. At the same time, you need to have your emergency fund and also your insurance. This strategy is not very different from a salaried person, but how it becomes of more importance to someone who's just a self-employed person.
Like for a salaried person, generally, we have our employer's health insurance. But for as an entrepreneur or as someone who's starting out now, you may not have that cushion of having an adequate health insurance policy, not only for yourself, but also for your family and dependents. So the first thing which you need to do is that get a term insurance for yourself. Understand that what is a financial risk which my family will have in case if something were happen to my life. So if you're say in your early 20s and you want to be an entrepreneur, for the next 20-30 years, whatever income you feel you will be contributing to the family, that needs to be replaced by a term insurance policy in case if there's some adverse situation on your life. So a term insurance is must, irrespective whether in your 20s, 30s, 40s. An X multiple of your annual income, which you feel will be your annual income, is a must. And health insurance, not only for yourself, but for all the dependents in the family, is absolutely must. At times, most of the families do have health insurance, but as the parents are growing older, the need for health insurance also keeps going up. So regularly keeping that checks and balances in place, that as the family is aging, do they have that adequate health insurance? And apart from that, a personal accident and disability policy is also a must, because at times when we are young, we don't really think of mortality, but it may happen that there could be some, small accidents which could take you out of work for some time. And at that point of time, something like a accidental disability policy can be very handy. So these are a few things. And like you rightly said, the emergency fund, irrespective of whether you're starting out, you're in your mid-30s, you have an established business, whatever is the 6 months expenses, the personal expenses, that should be parked into an emergency fund, an ultra liquid kind of a mutual fund or something, a liquid funds, where you can access that funds, on just a trigger. And even for your business, at least 6 to 12 months of your business expenses should be parked in emergency fund, even for the business. In the COVID times, we had seen a lot of entrepreneurs faced a lot of challenges because suddenly the incomes dropped substantially, but the expenses were same. They had to pay rents, they had to pay salaries. Okay, at that point of time, for the people who had created that emergency fund, it came in handy. But a lot of businesses had not planned for something like a COVID. And so both at the personal level and at the business level, maintaining a 6 to 12 month of expenses as an emergency fund comes in very handy in such situations.
All right. Considering the fact that you don't have a regular income, and if there's someone who gets money in chunks or maybe in lump sum, how would you advise them to, balance it out between their expenses, their investment strategies? First of all, the money is coming in lump sum. Irregular intervals, and at the same time it's not even the fixed amount of money. So in this scenario, how do you figure out your financial plan? Because your expenses are fixed. Okay, you might have specific goals also for, and you might also know how much you want to invest for those particular goals, but the fact that the income is not fixed, and it might just depend on whatever kind of work you get, project based maybe. How do you sort out a definite and a fixed financial plan in this scenario?
In this scenario, you just need to have like whatever is that basic bare minimum living expenses, what we call as needs. We bifurcate our expenses between needs, wants, and luxury or discretionary expenses, which you can postpone. So, what is absolutely necessary? The needs, okay, and whatever are the key goals. So, for someone who's just starting out, maybe the goal might be to get married, to have a house. That is what he can immediately see. Okay, so for him, that goal is sacred. For someone who's in his 30s and who's started a family, for him, probably kids' higher education, his own retirement is a priority. So, whatever is that absolute amount which you need every month for your living expenses, plus for that one or two very critical or sacred goals, as we say, that amount, you need to have that number in place. For some, it could be 50,000 a month. For some, it could be 1 lakh a month. So, that's annually 6 to 12 lakh rupees. So it's okay if you cannot invest that amount every month. You can invest a lump sum and you can set up a systematic transfer to whichever eventual asset class you choose. Say, for example, you're investing for a goal which is 8 to 10 years, then you can choose a diversified mutual fund portfolio, and you can put that amount in lump sum in a liquid fund and set up a systematic transfer every month to that diversified equity portfolio and stay invested for a little longer period of time, say 8 years, 10 years, till your goal comes. So it's okay if you do not have that monthly income coming in or the amount is not fixed. What is the withdrawal which you will make? It could be monthly, quarterly, or if you cannot make it monthly, quarterly, in a year. This is a take home which I will take out of my business, which will cover my living expenses plus my important goals. And if the goals are a little long term, I will park it in a diversified mutual fund portfolio. This is something which you need to keep in mind, while you are doing the asset allocation and planning your investment portfolio.
All right, Nehal, thank you so much for being on the show today and helping our viewers with this financial strategy that they can adopt.
Thank you so much.
Time
Thanks.
to slip into a short break, but then that, let's talk about your maturing fixed deposit. Would you want to put this money in equity markets? And if yes, what would be the route for you? Let's discuss all of this, but after this break. And before I go into that break, we have a WhatsApp number and email ID which you need to note down if in case you have any mutual fund portfolio related queries. Send us your queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on the moneyshow@etnow.tv. More on this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapriyal. Broader markets have seen a meteoric rise this year, but will this rally sustain going ahead? We spoke to Sanjeev Passi, Director, IIFL Securities. Listen in.
Mid caps have been stellar in the last 4 to 6 months. And that is actually telling you that, you were missing the woods for the trees, because most people were tracking the Nifty between 18.5 and 19.5. But mid caps were doubling, tripling, and even going more than that. So it tells you that the sheer underweight and ownership pattern of a lot of the PSUs, particularly railway, defense, power, these have been, very, very unsettling sectors for the last 10 years. And lo and behold, in the last 1 year, they have been the most stellar wealth creator. The under ownership continues to be a sore spot. And, there are enough people who are calling it for a top and so on. They may be, when stocks go up 300%, if a 20% the downside happens, there will be alarm bells. But in no way can you change the future of these companies. These are now trending now for the next 3-5 years. And in the short run, yes, there is a little bit of froth. but I think it will be an evening out pattern. I still think there is room on the upside, and you have to be invested in these stocks. And if you have held them, Kavita, over the last 3-4 years, then only you are laughing your way to the bank.
All right, so there is upside room still left. But then, having said that, Sanjeev, what are the kind of valuation in terms of sectors that you see are very comfortable in this mid cap, small cap category specifically, where you see more upside?
So see, there will always be earnings to catch up. These were very, very good dividend plays by itself. I'll give you a brief. 7, 8 year, 10 years back, a Neyveli lignite used to be at 11 rupees and it used to give 11% dividend. PFC REC gave 11, 12% dividend just till 2 years back at 90 rupees. Now suddenly those stocks are up three times or 5 times in the 7. And I'll just give you a brief. 3 years back, we suggested the CPSE ETF around 15 and 17 rupees. Today it is 53. So it tells you that there was a lot of value in these stocks, but they, flattered to deceive. They remained range bound. There was always pessimism. But lo and behold, suddenly the government's directive, the government's policies all have played out. And for once, the capex, the capex with the government, the private and the public both are deciding is going to be humongous. So irrespective of the short-term volatility where you can see maybe more, profit booking, the longer-term trend as far as defense, railway and power, all are very, very sweet. I'll just give a brief. DHBVN, where I stay in Gurgaon, is a government-owned power sector distributor. After 35 years, they're giving a different dividend of 6%, which tell you that we are power surplus, and from the three parts of power, that is generation, distribution, and the distribution losses have totally gone. So the lenders have been in a very sweet spot, and so have the distributors. And I think power and railways both are looking very good with the next 2 years, 3 years.
Okay, so these are the sectors and stocks that one can look at. But then specifically, let's just talk about microcap. And before we get into the nitty-gritties and much more detailed explanation about this category, do you really think it is healthy for an investor to be putting money in this microcap space, which is gaining too much of traction, be it a trader or maybe even fund managers, with AMCs launching and microcap index. So there's a lot of frenzy going around with this particular category.
So Kavita, first take it in a pinch of salt. In the last 4 months, mutual funds are unnecessarily had raised in excess cash, and they missed this rally. In fact, you see the NAV of most mutual funds, they have not even been able to beat the index, which tells you that the mid-cap frenzy is actually now a reaction, which is a late reaction, and them getting on the bandwagon. In the near term, there may be not that much of returns, but if you have a 3-5 year window, then some of these businesses can be tremendous. Look, I track stocks on market cap, and the market cap in the last 2 years was so abysmal that you could have bought anything and made money. Now, as the market realizes and the market caps get more, larger, you have to wait for earnings and the catalyst with that. But I still think that these three sectors, particularly railways, power and defense, the guideline of the map which the government has is very, very strong. Plus, Make in India is a very, very strong theme, and anything to do with that is going to be a very, very big beneficiary. But like you said, if I again could recommend, I would say that the CPSE ETF, which comprises about 12 of these stocks, is a very good basket. So try and select a good mutual fund which has exposure, but do not try and be individually, too sharp. In fact, take a basket of stocks and try and make a portfolio. But like you rightly pointed out, Kavita, in the near term, there doesn't seem to be that much of an upside. But if you can enlarge your horizon, then you will be sitting on good businesses which can enlarge over the next 3 years as earnings and the capex start to mature.
Sanjeev, any word of caution for microcap specifically for investors looking, because these days the kind of questions I get on my show, people just have mid-cap, small cap, and even within that, they really want to focus on building their portfolio in microcap. What would be your word of caution?
So my word of caution is don't get too carried away by the momentum. Momentum and feeling of missed outs are not too good. in fact, some of the large cap today, look, we made, despite the carnage yesterday on mid caps, today we hit an all-time high, and the bank nifty was roaring, which tells us that fresh money is going to go into large caps, and the large cap underperformance may be coming to an end. I would still say 50% must be in large caps at 20,000 plus, because the room for comfort over here is only in large caps, where earnings and the valuations are still reasonable. In mid caps, you will have to enlarge your horizon, and don't put whole hog money into mid or micro. Consult your RM, consult your business. IFL Securities does this full time. Consult your RM, consult your mutual fund. Take some advice and try and balance your portfolio. Going whole hog at this time when indices have double, triple is very difficult. But like I said, it's a glass half full, half empty. There is a feeling of missed out, and people will latch on to any idea. So ideas are plenty when the market is bullish. Only when the tide turns do you realize, how many people have been left in the lurch. So caution definitely over here. Balance of portfolio is a must.
Large cap. Let's just focus our conversation on this now. According to you, comfortable valuations in which all sectors as far as large caps are concerned now?
So, see, across the board, whether it's cement, whether it's banks, whether it's select autos are giving you an opportunity, or it's the telecom. I mean, Bharti hit a new all-time high, and so have the PSU banks. So PNB hit a new high, Bank of Baroda. So like I said, there is a lot of action in the large cap stocks, or large or semi-large cap stocks, which have a credential behind them, where there is transparency of earnings, where the earnings trajectory seems to be good. And that is where you should be putting. I like some of the specialty chemical names. Just to name a few, as a disclosure, we have positions in these: SRF, Chemplast, Sanmar, Jubilant Ingrevia, Naveen Fluoro. These have been out of fashion because of a Chinese slowdown. But now with a lot of the specialty chemical prices coming back, you can add a Tata Chemical. These give you a very good risk reward, because as soon as the tide turns in maybe in China and other places, specialty chemicals will again be back in demand. So that is one neglected sector which you can start to look at. And I think real estate and construction will remain to be outperformers. So pick your winners over there, but be in slightly more higher market cap stocks where visibility will be better.
The next trigger for the markets, do you think, would be earning numbers now?
I didn't get that, Kavita. Could you repeat?
Sure. So the next trigger for the market would be earning numbers now. That could give direction.
Look, firstly, let's see, we are in a bull market and we are at all-time highs. Secondly, the left out feeling for even foreigners has been humongous. India's demographic premium is standing out, and we know till the elections or the budget, there seems to be no big negative. On the other hand, once we get a plateau on rates, I don't think the Fed is going to raise rates for a long time. And I think once the yields start to soften over there, and inflation, which is more or less now coming to 3.5%, that starts to, even out over there, we could start to see, a lot of action in emerging markets. The bane for emerging market has been rising yields, a stronger dollar, and higher inflation. All those three are now being priced in. I still think earnings, yes, will be the catalyst, but the sheer weight of the retail investor, I repeat, the retail investor is the wall behind this rally. And as long as the SIP continues, Kavita, you will have expensive valuations in India. And if you can choose your winners when sectorally, you're still going to make a lot of money.
So in this current scenario, it's also very important to understand how not to be in a very over-diversified situation in your portfolio. So how do you analyze if you are really over-diversified in a particular sector or in a particular market cap situation? Is it the time for you to maybe analyze things depending on your time horizon, or maybe the way you have allocated a particular market cap in your portfolio? How can one just look at it?
So three things stand out. First is your risk profile, your age profile, and third is your portfolio. Your risk profile tells you whether you want to be in those high beta plays which can generate faster returns, but can then equally be on the negative side. Second is, what is your age outlook, in the sense, are you risk averse, or you are, closer to the age of 50 where you want to be balanced, maybe in a hybrid or maybe in some defensives or some bond portfolio. And if you are in the young age category, then new millennials are going to ride their way. You will not get businesses like Zomato or a Paytm or a PB fintech cheap. They will be expensive because the future belongs to them. And I think fintechs are the way forward. However, like we said, you have to rebalance your portfolio maybe on a quarterly or a month or a 6 monthly side. And that's where you need professional advice. So either consult your broker, your RM, or then diversify in the mutual fund which you own. But like I said, it is not a glass half full, half empty. Just being invested, Kavita, can be superlative, just like we've seen in the PSUs or the sectors which have outperformed, which is nothing for 10 years, but in 3 years they've done all what they had not done for 10 years. So just being invested sometimes in good businesses can be extremely rewarding but frustrating in the short term.
All right, so that's the word coming in from Sanjeev Bhasin. Thank you so much for being on the show and helping our viewers with their portfolio strategies today. Welcome back. You're watching The Money Show with me, Kavita Thaplial, and that part of the show where we answer viewer queries, because there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have Pankaj Matpal, MD, Optima Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Pankaj, and welcome to the Money Show. And let's begin the question answer session. I have Mr. Vinay MR's question first. He says that he's retiring and has 1 crore corpus amount. He would like to know the avenues where he can invest this amount for almost 8% guaranteed regular returns per annum, with principal being safe at the same time. So clearly this is his entire retirement corpus that he's collected, and he might want to use this for his post-retirement life and also have a regular income from this investment. So no risk investment instrument right now, that is something that you might want to suggest?
Kavita, good evening. Because he has clearly mentioned that he wants something where the principal is safe. So first thing is senior citizens savings scheme. For senior citizen, this is one of the best schemes available in this category where your principal is safe and returns also, because right now the rate of interest is 8.20%. And if he invests in this scheme now, the rate will be locked for next 5 years. The maturity is 5 years of this scheme. So interest is paid on the quarterly basis, and the scheme is available in designated post offices plus government banks, public sector banks, and as well as few selected private sector banks. So he can deposit up to 30 lakh rupees in his account. And if, for example, a spouse is also a senior citizen, in that case, additional 30 lakh can be invested. So that is one choice. Apart from that, there are Government of India floating rate savings bonds, which are issued by RBI on behalf of Government of India. These have a floating rate interest, but as of now, 8.05% is the rate of interest applicable. But that is reviewed every 6 months. So maybe it may be a little lesser or more, but that is another choice where the principal is safe and it's a government-backed scheme. So he can invest in that. There is no upper limit. But as a suggestion, if he can take little bit risk and some part of his portfolio he wants to invest in mutual fund, then some conservative hybrid funds or equity savings funds are available. But because he's not available on the phone, so I can't comment much. But as capital is not protected there. But to beat the inflation, one must consider a small part of portfolio at least in some equity-oriented schemes or some hybrid scheme. So that is also one suggestion. But as he had mentioned that he
Pankaj,
wants
just talking
something
about
where
senior citizen savings scheme.
So
Pankaj, just talking about senior citizen savings scheme, how can you ensure that you have regular income via this investment instrument? Is there a facility where you can decide monthly income or maybe quarterly or 6 monthly?
Kavita, see, it's only a quarterly option. Your interest is paid on the quarterly basis and you cannot change it. But as you know, if you need monthly cash flow, you can keep that in your account or you can use as it is. But from the government side, that is paid on the quarterly basis only.
All right. Any other safer instrument that you might want to recommend to him? Maybe a debt fund or anything similar to that he can maybe have his investment also going. Some part of it maybe in equity, as you also suggested that if he can take a bit of risk, then maybe a balanced fund would be good for him where he can have a SWP.
Kavita, see, one thing I suggested that Government of India floating rate savings bonds. So that is another choice where the capital is protected. But as I mentioned, not even balanced fund, if we can invest in some conservative hybrid funds or equity savings funds. Why I'm saying this? Because he has clearly mentioned in the email that he wants capital to be protected. In mutual funds, whether it's debt funds or equity funds or any kind of mutual funds, neither returns are guaranteed nor the capital is protected. So considering that fact, I mentioned, and you also means you said the same thing. He should have some exposure in equity through hybrid funds or through any funds, or at least debt-oriented mutual funds, as you mentioned. But the fact is that he should know his risk appetite. If he can take the risk of volatility, he is comfortable with this. Then only some part he should invest in mutual funds. But from my side, I'll say only one thing: to beat inflation in long term, one should have some exposure to equity.
All right, we move on. Our next question is from Chandan Jain, and he wants to invest 50,000 and that too a tax saving option. He wants to know about ELSS fund. So let's just begin with the kind of tax benefit you have in an ELSS fund, and how is an ELSS fund different from a normal or a regular mutual fund?
See, Kavita, first thing, these are equity fund essentially, so invest in equity only. So you can say these are kind of flexi cap fund, because there is a choice to invest across the market segments. But it depends on fund, from one fund to another fund, that where they have allocation. And most of the funds have major allocation in large cap, followed by mid cap. And tax saving under Section 80C of Income Tax Act, the taxpayers get the benefit of deductions, but that is available only under old tax regime. So if you are filing your ITR under old tax regime, then only you can claim deduction on these ELSS. Second thing, there's a limit of 1,50,000 under Section 80C of Income Tax Act. So it is a combined limit. So maybe that you are paying your children's tuition fees or principal amount of home loan, or you have already invested in PPF, or you are contributing to Employee Provident Fund. So put together, the limit is only 1,50,000. So that you have to keep in mind. Now coming to schemes, I'll suggest two schemes here. One is Motilal Oswal long-term equity fund. Another one will be Mire Asset Tax Saver Fund. So these are two schemes I can suggest him, and both are very good scheme. Only difference is that Motilal Oswal long-term equity fund, it has a focused approach. It has a little concentrated portfolio. But this Mire Asset Tax Saver, it has around 66 stocks in the portfolio. So it has a diversified portfolio. But both the schemes have consistent performance, history, and good portfolios.
All right. Considering now these funds have a lock-in of 3 years, should you be going the lump sum way or an SIP way? And if at all you are going to an SIP way, how to make sure that each of your SIP installment completes 3 years of time before redeeming it?
Yeah. Kavita, the most important thing is if somebody wants to take benefit in the current financial year, so definitely they have to invest the amount before 31st March 2024. Means on the amount what is contributed in this financial year, that will only be eligible for taking benefit for income tax. Second thing, if you invest through SIP, because lock-in is 3 years for the units from the date of allotment. So if suppose you invest from now and you expect at the end of 3 years from now, you want to redeem all the units, that will not be possible. Only units which have completed 3 years, those can only be redeemed after 3 years. So in that case, for example, you're investing for 1 year, and after 4 years, you redeem the first 1 year contribution. That could be possible. So considering that fact, it will be better if investor, they go for the lump sum investment, if that is possible for them cash flow wise, and otherwise means they should invest in such a way that after 4 years they invest the first year total investment, or otherwise most important or the best thing is that they should link this investment to their long-term financial goals and should not think about redeeming after 3 years. So after a few years, after 10 years, 15 years, whenever the goal is achieved, that time these units will also complete that lock-in period, and then they can redeem those units.
All right, let's move on. And the next question comes from Anil Mehta. He's asking, how is HDFC Sanchay Plus as an investment to save tax? So what kind of a retirement plan or an annuity plan is HDFC Sanchay Plus, if you might just want to spend a few minutes on this product?
Kavita, this HDFC Sanchay Plus is a non-participating, non-market link plan. Means it's not a market link, and second thing, there's no bonus. It is a guaranteed plan. But when we say guarantee, we have to see that how much returns you are expecting here. And I expect a yield of around 6% with this policy, depending on the age. So 6 to 7%, if you say even, then it is not very high in the long term. So I think that for tax saving, this is not the good choice. If you want something where your capital is protected, better you go for PPF, because ultimately limit is only 1,50,000 to claim deduction under Section 80C. So whether you invest in Sanchay Plus or you invest in PPF, the limit is only 1,50,000. And considering that fact, my suggestion will be PPF is a better choice. And otherwise, as we were discussing earlier about ELSS, if you have a longer investment horizon, though lock-in is only 3 years with ELSS, but as you are investing in equity, so ELSS is a good choice for tax saving.
What's the tax treatment for HDFC Sanchay Plus?
Yeah, see again, here the because from this year we know that your contribution up to 2,50,000 rupees, premium of 2,50,000 in one financial year, returns on that will only be tax free, and amount exceeding to that, when you get maturity of that will be taxable. So from that angle also, now these tax in these insurance policies are no more attractive.
All right. So what if you could just give us the normal range of premium for these kind of products, and what could be like the sum assured that's promised to you, and also because it's an annuity plan, right? So how do you get annuity after investing in such products?
See, there are multiple choices. It's not a pure annuity plan actually. It's a traditional insurance plan, and you have multiple choices here, whether you want a lump sum maturity benefit or you want to spread it over a period of time. So that choices you can opt for. And second thing, you said how much premium, how much this thing sum assured. That depends on age, and you have a choice that how much premium you want to pay. It's not like that based on the sum assured you have to choose the premium. But this is basically a saving plan. So as much as you want, you can invest in such plan.
Would you also recommend, along with ELSS, would you also recommend a senior citizen savings scheme?
Yeah, for senior citizens, definitely that is one of the good choices, sure. Because ultimately returns are good at this point of time. You are getting 8.20% rate of interest, and plus it is a government-backed scheme and 5-year lock-in. But only thing is that it is available only for senior citizens who are 60 years and above. So otherwise, if you are taken VRS, then the age is 55 years. So not everybody can invest in those schemes, but for senior citizens, definitely they should think about that.
All right, let's move on. And the last question of the day, this is, okay, I don't think I have the name of the viewer with me, but he says that he's 40 years old and he's a government employee, and he's doing 17,000 SIP, HDFC Retirement Savings Fund, Parag Parikh Flexi Cap, SBI Small Cap. He also has Tata Digital India Fund, Kotak Blue Chip, Kotak Emerging Equity, Franklin Smaller Companies Fund, Franklin Build India Fund, and he has 25 lakhs corpus, and he's going to retire in Jan 35. How much money can he expect from his investments? And also he has investments going on in NPS, and the amount so far is 10 lakhs.
Kavita, considering this 25 lakh corpus plus the 17,000 rupees per month SIP, if we calculate at the CAGR of 12%, so he can expect around 1.36 crore at the time of his retirement. Plus, he has contribution in NPS, and in NPS, it depends that what is the underlying portfolio, because the subscribers, they get choice whether they want to stick to default option or they want to invest more in equity. So depending on that, if I calculate at 8%, because I do not know the allocation, so I'm calculating at 8%, so he can expect around 2.38 lakhs with his contribution. I don't know how much he has already accumulated, but considering that what he's contributing now and what he has in his portfolio right now, so based on that, I'll say that he can expect around 2.38 lakhs at the time of retirement. And as we know, in NPS, up to 60% of the total corpus can be withdrawn in one lump sum, that is tax-free, and minimum 50% has to be utilized to buy annuity. So that will be available with him. And as far as mutual fund schemes are concerned, though he has 8 schemes, and in each category, he has more than 1 schemes also in some categories. But the schemes are good. He can continue with these schemes. Only concern that he has 2 small cap funds and also 2 sectoral or thematic funds. So as he is near to his retirement or after 5 years from now, he should switch from equity funds, especially from these sectoral funds or from small cap funds, to less riskier funds like debt funds or conservative hybrid funds systematically.
All right, I think that will be all for today. Thank you so much, Pankaj, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but then I'm going to leave you with our mobile number, our WhatsApp number, and our email ID. So you can send us your queries on our WhatsApp number, which is 865-797-4571, and email ID is themoneyshow@etnow.tv. Thank you so much for watching. Goodbye.